are a number of different types of business organisations that you need to be aware of. In this pod, we'll examine public limited companies.
A limited company is its own separate legal entity. This means that its owners are not personally liable for the debts of the business. There are two types of limited company: private limited companies and public limited companies. A private limited company is one where all of the shares in the company are held by a small group of private owners. For this reason, private limited companies are restricted in the amount of capital they can raise.
Public limited companies, on the other hand, aren't restricted in this way, making them suited to large multinational corporations that require billions in capital investment. Ford, Tesla, Amazon, Facebook, and Apple are all examples of public limited companies, or PLCs for short. A PLC has limited liability and can issue shares to potential owners much like a private limited company. However, the main advantage of being a PLC is the ability to issue shares to the general public. Remember, shares are equal parts of the ownership of a business. Someone who owns at least one share in a business is known as a shareholder.
Public limited companies can trade on the stock market, and anyone can be a shareholder if they have enough money to buy a share. When a company becomes a PLC, it's known as floating on the stock market, or an initial public offering. This is often abbreviated to IPO. The main advantage of being a PLC is that a company is typically able to raise much more capital than a private limited company. Investors buy shares in the company in the hope that the business will grow, and they will later be able to sell their shares for a higher price. Another advantage of being a PLC is that it can increase the status of a company and give it a more reputable presence.
There are some disadvantages to this structure, though. Compared with a private limited company, a higher commitment of capital is required initially, and listing the business on a stock exchange is also very expensive to do. It also requires a lot of detailed paperwork to be completed. Public limited companies are subject to stricter regulation, and much more detailed financial information about a PLC is made available in the public domain. This allows anyone looking to invest to make informed decisions, but also means that a PLC's accounts are subject to much more scrutiny and that business rivals have access to more information to potentially exploit.
As a shareholder, anyone who invests in a public limited company is entitled to a percentage of its profits in the form of dividends. This means that the profits are divided between many more people, but that the risk is shared more widely too. Another issue is the divorce of ownership and control. This means that the people who are running the business may not be the ones who own it. There are thousands or even millions of shareholders in a large PLC, but a much smaller number of people on the board of directors. The shareholders who own the business are likely to have little say in its operations.
Shareholders try to maintain control by voting on decisions each year at the company's annual general meeting, or AGM. For example, shareholders appoint the board of directors and vote on key decisions. A consequence of this is that the individuals who initially founded the business can lose much of their control as the company grows into a PLC. Mark Zuckerberg now only owns around 30% of Facebook, although he still maintains a senior management role. Facebook became a PLC in 2012, a move that raised $16 billion in capital and allowed Facebook to grow and acquire other businesses such as Instagram and WhatsApp.
Finally, a PLC is at a higher risk of a takeover. Because its shares are freely tradable on the stock market, anyone could potentially buy 51% of the company and acquire a controlling stake. For this reason, there are lots of mergers and acquisitions by PLCs, as companies seek to eliminate their rivals while expanding quickly into new markets.
The PLC model is only viable for the very largest businesses that are seeking a truly global presence. It's an incredibly lucrative source of finance but costs millions of pounds in banking fees.